The most durable incumbents in finance do not always fear regulation. Often, they help write it. Not line by line in some cartoon version of corruption, but through committees, lobbying channels, industry consultations, and risk frameworks. Through compliance working groups and the quiet influence that comes from already being embedded inside the monetary system. That is the structural truth. The public usually imagines regulation as a restraint on concentrated power. In practice, regulation often functions as a filter. Not a filter that removes the largest players, but one that raises the cost of entry high enough that only the largest players can pass through it comfortably. That distinction matters. Because once regulation becomes a cost structure rather than a moral boundary, scale itself becomes protection. The bank with a multi-billion-dollar balance sheet, an army of lawyers, and direct relationships with central banks does not experience a new rule the same way a startup, exchange, or crypto infrastructure operator does. The rule may be public, the burden is not symmetrical. That is where the misunderstanding begins. Most people still believe large financial institutions want less regulation because regulation sounds like friction, and friction sounds bad for business. But for entrenched incumbents, selective friction can be an asset. It slows new entrants, it centralizes trust, it channels activity back toward licensed balance sheets, and it converts political influence into economic advantage. This is not a theory about evil intent, it is a theory about incentives. If you already dominate a market, the ideal environment is not necessarily one with no rules. It is one with rules complex enough to keep challengers small, uncertain, undercapitalized, and permanently behind on compliance cost. That pattern is visible across banking history, securities law, payment systems, and now digital asset markets. When people hear more regulation, they often picture consumer protection. Institutions often hear something else. Higher fixed costs, credential barriers, reporting burdens, licensing thresholds, capital requirements, interpretive ambiguity, and longer approval cycles. All of those can be sold as public safety. All of them can also reinforce incumbent advantage. And once you understand that, the conversation changes, because the question is no longer whether regulation exists. The question is, who can absorb it, who cannot, and who quietly benefits when the architecture becomes too expensive for outsiders to navigate. That is the playbook, and if you are building in crypto, payments, custody, infrastructure, or any adjacent financial layer, you need to see it clearly, not emotionally, structurally. Because the system does not always defend itself by banning competitors. Sometimes it protects itself by regulating them into irrelevance. Start with the mechanism. Regulation imposes costs. Some of those costs are variable, but many are fixed. Legal interpretation, reporting infrastructure, audits, internal controls, licensing processes, capital reserves, examinations, and ongoing compliance staffing. Fixed costs matter because they hit small players proportionally harder than large ones. A bank with $500 billion in assets can spread a $50 million compliance burden across a vast revenue base. A startup with thin margins and uncertain funding cannot. That alone changes market structure. The rule may appear neutral in text, but in practice, it redistributes survivability. That is the first structural claim. Regulatory complexity tends to favor scale because compliance costs are easier to amortize across large institutions than across small entrants. You can see this in post-Minus 2008 banking. After the global financial crisis, major reforms like Dodd-Frank were presented as restraints on systemic excess. Some portions were necessary responses to real fragility, but the operational effect was uneven. Large banks absorbed the cost. Smaller banks and community institutions faced growing compliance burdens relative to their size, contributing to consolidation pressure over time. The result was not the elimination of concentration. In many ways, it strengthened the advantages of institutions already large enough to survive the new framework. That is not speculation, it is a recurring feature of regulatory expansion. The second structural claim is even more important. Incumbents often prefer interpretable regulation to open competition because legal ambiguity rewards those with established access to regulators. Rules are never just rules, they are interpreted rules, and interpretation is power. The institution that has former regulators on staff, dedicated policy teams, and regular contact with supervisory bodies has an advantage long before any enforcement action occurs. They understand what is likely to be tolerated, delayed, reclassified, grandfathered, or negotiated. A newer entrant often discovers those realities only after capital has already been committed. That creates another barrier: uncertainty. And uncertainty is expensive. In crypto, this has been especially visible. Large traditional firms have increasingly entered digital assets not because the space became simple, but because they can survive complexity better than native operators can. A regulated giant can wait, a startup burning runway cannot. So when regulation remains vague for years, large institutions are not always harmed first. Often they are protected by delay. That is the third structural claim. Regulatory uncertainty itself can function as a moat when incumbents have longer time horizons, deeper capital pools, and more political insulation than challengers. Now add the political layer. Why would policymakers tolerate this? Because incumbents offer something politicians and regulators value: legibility. Large banks are easier to monitor than thousands of smaller, faster, decentralized competitors. They are known entities, they have reporting channels, they can be pressured, supervised, and coordinated. In periods of stress, governments do not want an ecosystem they cannot see. They want concentration they can manage. That creates the fourth structural claim. States often prefer concentrated financial intermediaries because concentrated systems are easier to supervise, backstop, and influence. This preference becomes stronger when monetary policy transmission matters. Central banks influence the economy partly through banking channels, lending standards, reserve structures, credit creation, collateral systems, and sovereign debt absorption. Large banks are not just private firms. They are transmission nodes inside the monetary order. That means regulation is not purely about fairness. It is also about preserving policy plumbing. A fragmented system with too many independent rails reduces central coordination. An incumbent system, even if imperfect, preserves governability. That is why regulation often appears toughest exactly where disintermediation threatens established channels. Not because every innovation is unsafe, some are not, but because disintermediation changes who controls settlement, custody, credit allocation, and information. And control over those functions has monetary consequences. Look at payment networks. New entrants rarely compete only on user experience. They compete on margin compression, settlement speed, transparency, and infrastructure openness. That threatens fee structures. It threatens data advantages. It threatens the ability of incumbents to bundle services around regulatory privilege. So the response is often framed in the language of safety: anti-money laundering expansion, capital adequacy, risk controls, consumer protection, licensing, transaction monitoring. Some of these goals are legitimate, but legitimacy does not erase structural effect. The fifth structural claim is this: regulation can convert incumbent trust into compulsory market dependence by making formal permission more valuable than product quality or technical efficiency. Once permission becomes scarce, incumbents gain pricing power, not just because they are better, because they are allowed. And when permission is expensive, the holder of the license gains something close to a state-supported competitive edge. That edge compounds further through sovereign debt markets. Large banks are deeply tied to public finance. They hold government bonds, intermediate treasury markets, and serve as liquidity conduits during refinancing cycles. When sovereign debt levels rise, states become more dependent on institutions capable of absorbing and distributing that debt. That deepens mutual dependence. Banks need regulatory protection. States need functioning buyers and intermediaries for debt issuance. This does not mean every rule is designed by banks for banks. It means the system has aligned incentives to preserve incumbent financial plumbing. And once that alignment forms, challengers face not only market competition, but a policy environment tilted toward existing balance sheet power. The financial consequence is direct. When regulation is used as an entry barrier, capital, liquidity, and market trust become more concentrated inside legacy institutions, while innovation migrates more slowly, more expensively, and often under forced dependence on incumbent rails. This pattern is not new. Finance has rarely been an open battlefield where the best idea simply wins. More often, it is a layered system where law, money, and political legitimacy reinforce one another. Consider the national banking era in the United States during the 19th century. banking rules were increasingly tied to federal structures, chartering regimes, and bond-based requirements that favored institutions able to navigate centralized frameworks and align with sovereign financing needs. The system was not merely organizing finance, it was shaping who could participate under acceptable terms. The public language was stability, the structural reality was selective participation. A later example emerged after the creation of the Federal Reserve and the gradual consolidation of monetary authority. As central banking deepened, access to reserves, discount windows, and policy coordination created a hierarchy of monetary proximity. Not every institution stood at the same distance from the source of liquidity. That mattered most during stress. In normal times, the market looks competitive. In crisis, the architecture reveals itself. Those closest to policy liquidity survive more easily than those outside the circle. That is not only about better management, it is also about structural positioning. Another historical echo came after the 1930s and again after 2008. Periods of financial failure tend to produce regulatory expansion. Some of that expansion addresses real abuse. But it also tends to enlarge the role of the state in defining legitimate intermediation. Each crisis becomes an opportunity to redraw the threshold of acceptable participation, and each redraw tends to favor institutions already large enough to meet new standards. That is why crisis-era reform often produces consolidation, not democratization. The rhetoric is cleanup, the mechanism is scale selection. You can also see parallels outside the United States. In Europe, financial integration, banking supervision, and capital standards have repeatedly increased the strategic value of large institutions that can operate across multiple jurisdictions, manage reporting burdens, and interact continuously with supervisory bodies. Cross-border complexity sounds like a burden. For large incumbents, it is often a moat. For smaller challengers, it can be a wall. The same logic appeared in telecommunications, energy, and transport. Whenever compliance, licensing, or safety architecture becomes sufficiently dense, incumbents stop asking whether rules reduce total friction. They ask whether rules increase relative friction for competitors. That is the real game. Under hard monetary constraints, competition tends to revolve around capital discipline and risk judgment. Under increasingly managed monetary systems, competition often becomes entangled with access. Access to liquidity, access to legal status, access to settlement, access to policy interpretation. Over time, access itself becomes a competitive asset. That is why financial incumbents do not always resist regulatory growth. They often resist unpredictable regulatory growth, but predictable complexity, especially if it entrenches charter value and weakens newcomers, can be highly attractive. Today's digital asset environment reflects the same cycle. First comes innovation outside the perimeter, then comes public anxiety, scandal, volatility, or policy concern. Then comes the demand for formal rules. Then incumbents arrive with the institutional capacity to operate within those rules. The pattern is old, only the technology changes. The economic parallel to today is clear. Regulation repeatedly emerges not just as a tool for restraining excess, but as a mechanism for reabsorbing disruptive innovation back into structures already aligned with sovereign debt, central banking, and incumbent financial control. Now translate structure into market effect. When incumbents shape regulation into an entry barrier, the first major consequence is liquidity concentration. Liquidity does not simply flow toward the most efficient system. It flows toward the system perceived as safest, most durable, and most legally survivable. If regulation raises survival odds for incumbents while increasing uncertainty for challengers, capital will price that in. That affects funding, valuations, access to banking, insurance, counterparties, and settlement relationships. In other words, regulation does not just determine legality, it reprices trust, and trust is a monetary variable. The second consequence is purchasing power distortion through slower innovation. If incumbents can use regulatory architecture to delay lower-cost financial alternatives, then households and businesses remain longer inside fee-heavy, inflation-sensitive, intermediary-debendent systems. That means higher transaction costs, slower settlement, less competitive savings options, and continued exposure to monetary debasement through fiat structures designed around debt expansion. The cost is not always visible as a tax bill. It appears as lost efficiency, weaker yield, more intermediaries, and fewer alternatives. That is still an economic cost. A third consequence is risk redistribution. Heavy regulatory frameworks often create the appearance of safety, while moving fragility upward into fewer, larger nodes. This is one of the most misunderstood patterns in finance. When many smaller actors fail, the system looks messy. When a few giant actors dominate, the system looks orderly. But concentrated systems can carry deeper tail risk because failure becomes more systemic. So regulation that eliminates smaller competitors may reduce surface chaos while increasing dependence on institutions considered too important to fail. That changes moral hazard, bailout expectations, and sovereign exposure. And it changes asset pricing because investors begin to assume public backstops where private discipline should exist. You saw this after 2008. Large banks did not merely survive because they were prudent. Many survived because the monetary and fiscal architecture could not tolerate disorderly collapse at scale. That implicit backstop affects behavior. It lowers funding stress for protected institutions relative to unprotected challengers. That is a structural subsidy, even when it is not called one. The fourth consequence is asset repricing around regulatory privilege. Licenses, charters, banking relationships, broker-dealer status, custodial approvals, and compliant distribution channels all become more valuable when entry is restricted. This increases the embedded worth of incumbent infrastructure. It also means innovators are often forced to partner with legacy institutions instead of replacing them. That is how disruption gets domesticated. The technology survives, the independence does not. This pattern is already visible in the digital asset space. Instead of open monetary competition, you increasingly get gated exposure. Instead of direct participation, you get wrappers. Instead of sovereign control, you get institutional products. Those products may expand adoption, but they also preserve intermediation. And intermediation is where fees, surveillance, and control tend to remain. A plausible implication is that part of the next phase of financial integration will not be the suppression of digital assets outright, but their absorption into regulated channels that preserve incumbent custody, reporting, and transactional oversight. That would be a major strategic victory for legacy finance, not because innovation failed, because innovation was made to pass through legacy gates. Another observable pattern is the divergence between policy rhetoric and market structure. Public messaging emphasizes safety, fairness, and stability. Market outcomes often show consolidation, licensing scarcity, and compliance inflation. When those two move together repeatedly, you should stop evaluating policy by stated intention alone. You should evaluate it by who gains durability, who gains margin protection, and who becomes harder to displace. That is the financially relevant lens. And from a sovereign positioning standpoint, the lesson is uncomfortable but clear. If you build only where incumbents want you to build, you may gain short-term legitimacy at the cost of long-term independence. If you ignore regulation entirely, you invite fragility. But if you fail to see regulation as a competitive weapon, you will misunderstand the field. The positioning implication is this: rational actors should treat regulation not merely as a legal framework, but as a capital allocation signal, one that reveals where incumbents are defending margin, preserving control over liquidity channels, and attempting to keep innovation dependent on legacy financial infrastructure. Once you see the structure, the emotional framing loses its grip. The debate is no longer regulation good versus regulation bad. That is too shallow. The real question is what kind of regulation is being built, who can bear its cost, and whether its practical effect is consumer protection or incumbent insulation. Those are not always the same thing. In finance, they are often deliberately blended. That is why disciplined analysis matters. If you are a founder, operator, builder, or allocator, you cannot afford to read policy only at the level of headlines. You have to read it at the level of incentives, who becomes more legible to the state, who becomes more fundable, who gains distribution, who gains custodial legitimacy, who becomes dependent, who gets slowed down, who gets absorbed. That is the map, and it also clarifies something deeper. Sovereignty is not built by outrage. Outrage is easy. Stewardship is harder. Stewardship requires that you understand the architecture you are moving through. Monetary incentives, legal bottlenecks, liquidity dependencies, jurisdictional exposure, and the trade-offs between access and control. That is true in capital, it is true in technology, and it is true morally. Because responsibility begins where illusion ends, you do not protect what you refuse to understand. That includes money, that includes custody, that includes the systems that shape what is permissible. Bitcoin matters here not as a slogan and not as rebellion theater. It matters because it represents monetary infrastructure outside the standard discretionary gatekeeping model. That does not remove all risk. It does not remove the need for discipline. It does not eliminate state pressure or operational mistakes, but it does change the architecture of dependence. And that is why the regulatory capture playbook matters so much now. Not because every institution is coordinated in secret, not because every regulator is malicious, but because systems evolve according to incentives. And incumbents tend to support the forms of order that preserve their role inside the monetary machine. That is how power usually works in advanced systems, not through dramatic declarations, through standards, thresholds, permissions, reporting layers, and cost structures, quietly, procedurally, legibly. By the time the public notices, the perimeter has already moved. So the practical task is not panic, it is clarity. Build where you can maintain resilience. Understand where compliance becomes dependency. Understand where legitimacy is being priced as a competitive asset. Understand where innovation is being invited in only on the condition that it remains supervised, custodial, and absorbable. That is not cynicism, that is structural literacy, and structural literacy changes behavior. You stop confusing visibility with openness. You stop confusing formal permission with market fairness. You stop assuming that rules written in neutral language produce neutral outcomes. And once you stop assuming that, you can position more rationally. You can build with more discipline. You can allocate with more patience. You can separate genuine protection from strategic enclosure. That is what serious awareness sounds like: calm, precise, unimpressed by slogans, attentive to incentives. Because in the end, the system does not need to outlaw every threat to incumbent power. It only needs to make independence expensive enough that most people choose managed dependence instead. That is the playbook. And if you understand it, you do not need to react theatrically. You need to think clearly, build carefully, and preserve the forms of monetary and digital integrity that do not rely on permission from the same structures seeking to absorb them. This is 21 Protocol. Freedom is not a feeling, it's a structure. If you don't build yours, they will build over you.